Today in InvestTalk, we look at the decline in M2 growth and what message it is sending about markets. Then we look at the market movements after the inflation data today. And then we answer questions about Starbucks, Lockheed Martin, Lululemon, and more. And at the end, I look at what type of REITs have fared well as of late.
This is InvestTalk, independent thinking, shared success.
Our main focus point today is about M2 money supply, and there are various measures of how much money is in the system. And obviously, the more money in the system, the more liquidity, the more problems can be papered over. There's just more capital in the system in order to resolve any issues. Okay. And as of late, you've actually started to see a decline in what is called M2. Now, there's M1, there's M2. Now, M1 measures cash and coins in circulation as well as demand deposits in checking accounts. Okay, basically cash that can be immediately spent. M2 is M1 plus money market accounts, savings accounts, CDs, and CDs below 100,000. So basically capital that, requires a little bit of work, but is still extremely liquid and low risk, right? No risk. Okay. And so over the long run, as the economy grows, there needs to be more money in circulation. So generally, M2 grows year over year. Typically not by a large amount, but, low single digits. However, there was a period briefly over the past couple of years where M2 actually declined. Peak to trough, nearly 5% from April of 2022 to October of last year. Now currently, as of July at least, M2 is expanded by 1.4% year over year. About in line with kind of longer term averages. But that big drop in M2, did that align with the big drop in the equity markets? Right? Think about that. And, that was mainly focused on those big cap names, but you can see the power of an M2 falling. And you can also see it the other way. M2 skyrocketed. It was up over 26% year over year at the peak of the COVID crisis. And what happened to asset prices? They exploded through the end of 2021. Now, history says when you get a decline in M2 money supply, you have some sort of major bear market. And once again, we kind of had that. But I want to go back. We're looking at this because it's important to monitor where M2 is going, where liquidity is going, because that is a huge driver of where the stock market is going to go over the next 3, 6, 9, 12 months. And outright declines in M2 are very rare. Since 1870, M2 has dropped at least 2% year over year in only 5 occasions. 1878, 1893, 1921, 1931, 1933, and 2023. Now, some of those periods, we had double-digit unemployment and really economic calamity. But we didn't see that this time, right? There was a mild recession, you can call it. There was never an officially declared recession, but, based on 2 consecutive quarters of real GDP, negative real GDP growth, we did get that. But it didn't correspond with, credit crisis or any kind like that. And so, a lot of people might point to this and say, hey, M2 growth, it's meager, it's not that great, but if it has to really dip negative for things to get really bad. Okay. And so it's a vital stat to follow. We follow it. And we want to make sure that M2 growth is not headed in the wrong direction. And currently, like I said, it's still growing decently. And it's something that you need to continue to monitor if you want to know kind of the near-term growth of or expected growth of asset prices. Okay. So once again, as of the latest, July 31st, M2 growth up 1.26% year over year, that's fine. Not amazing, but it's fine. It's headed higher. And that means liquidity is solid and asset prices should remain relatively stable. Let's take a quick look at the market today, and it was a decidedly positive day, especially for large cap growth. We had the inflation number come in a bit hotter than expected, and what's interesting here, and this is a tell, you know, most people would say that, okay, inflation's hotter, the Fed is going to only cut 25 basis points now versus potentially 50 basis points, be less stimulative, and that would be negative for markets. But you have to not just take kind of the playbook from the past 15, 20 years. It's a different environment. It's an inflationary environment. And it's pretty clear that higher rates, and we've shown this before, outside of crisis periods, low rates are actually correlated with low inflation and low economic growth. High rates are associated with higher inflation and higher economic growth. And so markets bounced on this, meaning if the Fed is going to keep the Fed funds rate higher for longer, what does that mean? A bigger deficit, right? Because as they continue to refinance debt, it's going to be at a higher rate. It means that interest expense goes up, and that interest expense goes into the real economy. And so this is your signal, and you need to pay attention that this isn't your mother's central bank and your mother's economy. Okay, this is a new, modern iteration filled with a lot of government debt. And that interplay between interest rates and that government debt has a different impact than it did before. And so I think that's why you saw the market bounce. They're okay with, you know, the Fed keeping rates a little higher for longer. Yeah, the economy's weakening, but mainly in the low end. GDP growth is still, 2-ish%. Unemployment rate, while going up, is still, low fours. That's historically low. And so the market reacted nicely to this report that inflation is higher. And guess what? Inflation in the 3 to 4% range, that is very good for equities. Remember, in order to have a major drawdown in equities, you typically have to have a deflationary impulse. And what did the numbers say today? We're not in a deflationary impulse. We're still in inflation. And as I said many times before, the stock market and earnings are not priced in real terms, meaning inflation isn't backed out. They're priced nominally. And this is another reminder of that. So once again, pay attention and understand what the market is telling you. Because the market's always sending signals. It's your job to interpret it. And that's what we do, obviously, as professionals.
Hi, Dave from Ohio. I was calling in to ask about Chevron. The symbol's CVX. I own it, and it has a nice pullback. See what your thoughts are. Pays a decent dividend. I'll be looking forward to your answer. Thank you.
Well, the dividend shouldn't matter. Okay, shouldn't matter to you. Now, Chevron, it's a big bellwether within the oil space. And if you're looking at this name, you probably should be looking at Exxon as well. Now, a lot of people they say Exxon, it's yielding less, right? Its dividend yield is less, but its performance is much better as of late. Relative strength on Exxon is 40, and relative strength on Chevron is 23. So, and then you look at the earnings trajectory, Exxon is much stronger, more consistent. Last quarter, revenues are up 12%, earnings are up 10%. Chevron was that revenues were up 5%, but earnings were down 21%. So in this environment, Exxon's just holding up better. So I'm picking one or the other. I'm picking Exxon, and these are kind of the two within this class. Now you can go smaller, but there's more risk there, less diversity, and depends what you want. But it's like the Mag 7, right? If you're going to buy one of the Mag 7, you want to be buying the best of the best, right? And so, because you're taking similar risk. And so in this instance, I wouldn't be adding to Chevron. I would be probably rather buying Exxon or another name, right, that has even better valuations, better earnings growth. And there are plenty of those out there. They're just higher risk, and they tend to be smaller. Thanks for the call. Now, have you been telling your friends about the InvestTalk podcast and that it's available in video form as well by heading over to our YouTube channel? And we get questions submitted via the YouTube channel. So let's get to one now. Rowdy 1234567 says, recently you said you had your eye on Lulu. What is your current price target or buy target price in this name? Well, when you have a stock that's in a downtrend, what you are mainly looking for is its support levels. And I will say that it is approaching support level, which would be the 618 retrace down at about $220 per share. And it almost got there, kind of got there in earnest. About 225 was the low, 226 actually in change back in August. And it's now attempting to make a higher low. And the MACD is on the rise. And this is a name that's come down all the way down from 520 to 255 and change today. So I'm actually getting some signals here that Lulu may be bottoming. Obviously a very good brand with a loyal following. And they have a good balance sheet. If you look at they're pretty much no debt on their balance sheet. We love that. Its enterprise value to EBITDA is around 10. That's historically low. Now, obviously, the consumer does continue to get weaker, but this is a fantastic brand with great profit margins. So I'm starting to itch. I'm starting to say, okay, it might be time to get into Lululemon. Thanks for the call. Now let's keep things moving and pivot back to the InvestTalk voice bank. You know the number. It's 888-99-CHART.
Hello, gentlemen. This is David from San Jose. Had a question regarding a power utility company thinking about investing in. The stock symbol is AQN. I'd like to get your thoughts on it and a good price to get in. Thank you for all you do.
Well, a good price to get in is not get in. This is a name. It's out of Canada. And it's focused on renewable power generation. And we all know that most of those projects are just uneconomical, especially in Canada, right? There's not a lot of sun, so solar doesn't work very well. And there's a reason this name is doing so poorly, especially when utilities more broadly are near 52-week highs. Earnings are set to decline 13% this year after falling 15% last year. And then fall another 19% next year. And the technicals are just negative, just consolidating here around $5 per share and likely to head lower. So absolutely pass on AQN.
Hello, my name is Brett. I'm calling from Long Beach, California. Just wanted to get your feedback. I've been investing in pretty heavily on Starbucks with their new CEO coming over, but just wanted to see what your insight is on that stock and see if it's a good longevity one for long term. And it's Starbucks. And then my other one is, if you have time, is RTX Raytheon. I just feel like it's, I know, seems like a good company. It looks like they're getting a lot of investments and contracts. So thank you very much. Looking forward to listening on the podcast. Great show.
Well, you're looking at two different types of companies, obviously. We own Starbucks. We picked up Starbucks on the dip into the mid-70s. Now it's about 98 and change at the close today. So we really liked it down there. It was at major support. Valuations were good. Now, obviously, it's a bit higher. We still like it. And we like the change, the new CEO. So we bought that before the change. And I think there's a lot of work to be done. It's just obviously a great brand with great distribution, install base, and I think there's a lot of upside potential there. But I don't think it's going to happen overnight. Okay, it's rare that a CEO can come in and right the ship in a very short period of time. It takes years. Developing a strategy, then implementing a strategy, and perfecting that strategy. And so, you're probably going to get more volatility in Starbucks, and, I'd be buying in more of a dip. Obviously, I'd like it back in the 80s to pick up more versus the high 90s now, but I'd much rather own this than Raytheon. Raytheon does have, obviously, a lot of government contracts, but look at our debt situation. How much can we really afford to continue to spend as much as we do on military? So, and then, they loom large of a new administration coming on board, changing policy, whether that's the Harris administration or a new Trump administration. Either one is going to probably shift their policy to a degree when it comes to foreign relations. And so, while Raytheon's in an uptrend, it's fine for now. I worry kind of medium to long term with it. So I'd much rather own Starbucks versus Raytheon, but obviously very, very different types of companies. Now let's talk a bit about the market rotation that's going on right now. And what's interesting is that the big tech names are no longer the only game in town. Since last Thursday, the Russell 2000 has been up 7%. 7%. But if you look at, and this was as of last week, and so, and the Mag 7 was down, and so what you're seeing here is a pretty stark shift in what's happening with small caps versus those mega cap names. Now today was a bit of a change, but one day doesn't make a trend. The trend really started it kicked off July 11th. And it's been continuing. And what are the main reasons? Well, the Fed is cutting rates. And we know that those mega cap names, they have a lot of cash sitting on the sidelines. They're earning high interest. And if the Fed cuts rates, well, that's less interest income for them. Whereas small cap names, they tend to have a good amount of debt. And lower rates obviously allows them to potentially refinance that debt at lower rates and just overall clean up their balance sheet a little easier. Okay. And the equal index continues to outperform. And you're just seeing that general malaise with those mega cap names, once again, outside of today. Okay. What did NVIDIA do today? Yeah, that was up. But what you're really seeing is that the growth last year in the S&P 500, when it came to earnings, was driven by those top, Mag 7 names. The rest of the S&P 500 was in a technical profit recession last year, but that's starting to shift, right? They're the ones that are coming out of the doldrums, whereas those mega cap names, the growth is starting to slow. So from a fundamental perspective, they're no longer the only games in town. Okay? Especially when you go and look at whatever new administration we have next year, it's, okay, what type of policy is going to be implemented? And that's most likely to help the smaller businesses, more domestically focused businesses. right? So that's a trend that I think is just beginning and will likely kick off in earnest once we get through the election. And there's a lot that is likely to change. That is in either direction will be good for those small cap names. So be on the lookout for that. Understand how your portfolio is aligned. What type of weighting do you have in your portfolio? Do you have a lot of mega caps and large cap names, or are you well diversified into the mid and small caps that will benefit from lower interest rates and industrial policy that is more domestically focused? All of these are vital to understanding the future trends within markets. There's another question that came in from our InvestTalk YouTube channel. The Divine Feeling says, any thoughts on KOF as a play into Central American markets? Now, this is KOF. This is Coca-Cola Femsa. And this is a Mexican company engaged in bottling Coca-Cola beverages in Mexico, Latin America, Brazil, and Asia. And yeah, historically, this has been a great play on Latin America. Very profitable, good balance sheet, just continues to grow. Obviously, the population there is very young, growing, and they tend to drink a lot of Coke products. And so earnings, while they are supposed to fall 20% this year, that was after being up 48% last year. And earnings are expected to grow 13% next year. And those numbers are being upgraded as well. So I like it. A big company, 142 billion, but very profitable. Return equity at 16%. And once again, in a typically operating in environments that have good economic growth. Obviously, Mexico, we like Mexico, but there are a lot of South American countries that are moving in the positive direction when it comes to their broader economies. And then you get into a dollar situation, right, where the Fed is going to cut rates. The dollar is starting to weaken, not just against the yen, but against a lot of other currencies. And so this would be a solid play for that. It has pulled back from about $102 per share, and it's starting to make, looks like, a higher low here, right around $85 per share. So I'm going to give this one a thumbs up. The technicals are kind of neutral more than anything, but in the medium term, but over the long term, tends to stay in an uptrend. So I'm going to give Coca-Cola Femsa a thumbs up. Well, let's play another question now on an 888-99 chart.
Hello, my name is David from San Luis Obispo, California. Would you take a look at Cavco Industries, ticker CVCO? It's a manufactured home building company. I've been buying the stock the last 2 months, and I think it's at fair value. What's your opinion on it? Thank you.
All right, looking at Cavco, and in an environment where we need more homes. I get frustrated by politicians on both sides of the aisle, because when they're talking about the home crisis, they talk so much about, how do we increase demand, right? How do we get people into homes? How do we give them incentives, tax breaks, things like that in order to buy a home? But the reality is that's not the issue in vast majority of cities and the country more broadly. It's about supply, bringing on new supply. It's very difficult. And so in an environment like that, where politicians are not looking in the right place, they're only focusing on demand, they're not focusing on supply, Cavco is one that can fill that need. Manufactured homes. There's a lot of older boomers, didn't save enough, right? And, a manufactured home might be their best bet of, keeping a roof over their head, because they don't have the, financial well-being to make that happen. Especially in an environment where, inflation is biting in many ways. And so this is a cost-efficient way in an environment where hey, affordability is bad in many parts of the world. So I'm going to give Cavco a thumbs up. Very profitable, 16% return on equity, good balance sheet, and once again, filling a vital demand. So I'm going to give CVCO a thumbs up, even though they don't pay a dividend. A lot of people ignore it, but I think it's good. Let's go talk to Phil in Northern California, looking at Rowe Price. How you doing, Phil?
Hey, Justin. Pretty good, thank you. I missed the beginning of your show, but I just wanted to say happy birthday.
Oh, thank you. Well, you must have caught enough of it.
How old are you now? You're like 44 or 43?
I'm 41. 41.
41?
Yeah.
Oh, okay.
41.
Wonderful. Well, congratulations.
Thank you. Made it this far. Did you have a stock question?
Hang in there. Well, yeah, about Rowe Price. I've had it for a while, and I bought it. I bought and I've sold some shares when it was higher, and I bought. I think I own it mostly down around the low 90s. But I just wondered what your take on it is, general, kind of as more of a long-term hold. But even in the next year or two, with the interest rate thing, how you would view this company?
Well, T. Rowe Price, for everyone else out there, this is a large investment group, asset management group, and they have a lot of mutual funds, typically actively managed mutual funds. 51% are in equities, 34% are balanced funds, 12% are fixed income or money market, and 3% are alternatives. So it's very focused on equities typically. And we know throughout the last 20 years, money has flown out of active funds and into passive funds. And so that's why T. Rowe Price, despite being very profitable, their business has been very up and down. And this is a pretty leveraged bet on not just equities in general, but the index is underperforming kind of broader active funds. And I think in an environment where value outperforms, that can happen. But I think it's going to take a longer period of value, small caps, mid caps outperforming for this to really gain much traction. Okay, because investors are going to have to start to realize that and start to reallocate capital outside of indexes and back into more active funds. And that's a big bet, right? That there's going to be a shift in market structure, a shift in how investors are allocating. And their habits so far over the last 20 years have continued to be more towards indexing. And so, it's a name that is interesting to me. It's a good business. It's a great balance sheet. But it doesn't get me excited because I am not sure that the average investor is going to be quick to catch on to the shifts in the market that are happening. Okay, and that's what you're going to need for T. Rowe Price to really start to outperform, because even though equities might go up, money is not shifting. It's going to take a while for money to shift. So I would not be owning T. Rowe Price.
Hey guys, this is George in Massachusetts. I was wondering if you could discuss the pros and cons of buying stocks on margin. I appreciate it, and thanks. Bye.
Well, it's just increasing your risk. That's it, right? You want to take the risk. You want to pay the margin interest. Margin is just leverage. So it's another way to take leverage or add leverage to your portfolio. Just like options are a way to add leverage to your portfolio. It works in your favor when things are going well, but obviously when things cut to the downside, your returns are magnified to the downside. So I always advise to take very minimal margin. If it's 1-2% of your portfolio, 3% of your portfolio, not a big deal. People get in trouble when they start getting into 15, 20, 30% margin, and that can be the death knell of your portfolio. So I'd avoid it if you can. Let's talk a little bit about REITs. And a lot of people, they buy REITs in their portfolio, and in order to create a bit more diversification, and get returns that are similar to, say, the real estate market, right? Because that's what you're investing in. You're investing in a real estate investment trust. So you would think that the returns are similar. Well, that depends. There's some data over the last 5 and 10 years, and there are looking at 5 broad categories of REITs. You have commercial, infrastructure, residential, data center focused, and just general REITs, broad diversified REITs. Now what they looked at is the 5-year average return, including dividends, as well as average volatility measured by what's called standard deviation. And what were the best types of REITs? Well, number 1 and number 2, kind of neck and neck, were data center REITs and general REITs. So broadly diversified as well as data center REITs. Data centers returned on average over 5 years 15.5%, and on a 10-year average 9.5%. General REITs at 15.18 over 5 years and 9.8 over a 10-year period. And this is annualized. What were the worst? Commercial REITs. On a 5-year average, only 7.8% and 7.4% on a 10-year average. And they had the highest level of volatility. So these are typically office REITs. So you can see the recent performance has dragged down the group as a whole. Now you might think rents have gone up on apartments. So residential REITs would be a good place, right? Not really. There was second worst of the 5. 10.4% over 5 years and 8.26% over 10 years. And infrastructure REITs were kind of right in the middle, okay, with the lowest volatility, middling returns, but not far off. If 13.6% over 5 years, that's about 2% less than the data center REITs, and 9.11% over 10 years, and that was at just a little bit lower than the 9.8% average for general REITs, with pretty significantly lower volatility. So if you're looking for the lower volatility REITs, still with good returns, those infrastructure REITs can be a good place to be. Now, how correlated are they with the overall market? Do they give you really broad diversification? Well, the answer is not really. Correlation with the S&P 500 is 0.89%. So effectively 90% correlation with the overall broad market. Now, they pay nice dividends, and that's what most people are looking for. They tend to be good in a tax-sheltered account, like an IRA or 401k. But don't think you're getting the same type of return profile or correlation that you get with an individual real estate property. But still, the returns are very good. It's just a matter of what sector of the REIT categories you're investing in. Well, that about does it. I'm Justin Klein. This is another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Independent thinking, shared success. This is InvestTalk. Good night.